Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we have a very timely topic for the week that we have just went through on risk and money management of trading. Because if any of you were long going into this week, you probably experienced a bit of pain this week. However, how much pain you experience is really contingent upon how much planning you did before you got into your trades around risk and managing the money in your account. So regardless of whether you're a retail trader, an advisor, or a professional trader, you're trading your own account. And when you're trading with discretion with options, you are potentially putting quite a bit of capital at risk. So one of the benefits of trading options is the fact that you have the ability to control your risk that's embedded into the option contract. For those of you that are buying calls or puts, they have limited risk. However, you still have to decide how many contracts you purchase, and how much you put of your portfolio at risk is heavily dependent on the planning that you do for how many contracts you purchase for every single one of these trades. So today, what we're going to go over is what is the math and methodology behind making sure that you control the risk around your portfolio in each individual trade. Make sure you get ahead of the curve for market downturns like the one we experienced this week, and really show you how you can survive bad weeks or potentially even bad months. And the good thing is that the thing we're going to go over here today does involve a little bit of math, but everything that I'm going to go over is very simple in terms of math, and I want to keep the calculations as simple as possible. And I purposely created worksheets to help you work through these numbers if you don't have access to Options Play. If you do have access to Options Play, all of the things that I'm going to be expressing to you here today are already built into your platform so that you can implement what we teach you here immediately for any trade that you look at within Options Play. Now, there are many ways to look at your portfolio risk and manage risk, but the overall goal of what we're going to do here today is to really make sure that we prevent any account blowups from weeks like today. Weeks like this week or months like December 2018. We want to make sure that when those months happen, that you are still in some way, shape, or form protected against blowing up your entire account. So if something like December 2018 happens again, you know how to position yourself for that, especially for these really violent corrections that we saw like the other day when the Dow was down 800 points. Many of you may have experienced a bit of pain. So we want to make sure that you know how to plan for weeks like that. So before I get started, just by a show of hands, if you can please type bring up your chat window at the bottom of your screen. Please just type P into the chat window if you felt that you've experienced quite a bit of pain this week going into that sell-off we had earlier this week, just to get a sense for the audience here in the room. So please type P if you felt that a little bit of pain, especially for those of you maybe that were long the markets, whether it's calls that you were owning or stock that you owned. Especially if you had a bunch of calls expiring around the same time, you may have had a lot of positions show unrealized losses. For those of you that had some puts, your week probably turned out a little better than others. But for those of you that had some calls or perhaps sold some puts, this might have been a bit of a painful week. So looks like I have quite a bit of responses here of users who said that they had a bit of pain this week. Now that is okay because each of us have, we're never going to be able to get into a point where we don't experience pain. But the goal here is today is to make sure that we understand how to control that so that you don't lose a large percentage of your account from a week like this week. So let's talk about this so far. For those of you that are brand new to Options Play, welcome. Today, we're not going to spend too much time using the tool, but I will bring up the tool at the end to show you how to implement what we're going to learn here today. For those of you that don't have access, you can sign up for a free 30-day trial using the link here below, which I will send into the chat window so everyone can sign up. And membership is only $75 a month or $500 a year. And you can access a free 12-step trading course to help you get started with Options Play, with with options trading in general, as well as daily trading ideas along with your access to this platform. So if you're brand new, sign up for that free trial to get yourself familiar with this platform. Now, today, what I'm going to go over is a few different things. I'm going to start off right off the bat, and I'm just going to talk about the golden rule of risk management to help you avoid having weeks that are extremely painful. Now, we're never going to be able to avoid pain altogether, but we want to make sure that the pain is never too much where you can't sleep at night. And in order to understand the golden rule of risk management, what we're going to do is we're going to work backwards. We're going to talk about the difference between a linear and exponential function. It's a simple explanation between the two, and it really explains why or explains the math behind why the golden rule of risk management applies to trading. And in order to understand that, we'll talk about the high water mark and what it takes to get back to your high water mark once you've had some losses. And we're going to talk about how many trades it takes to blow up your account and thinking about your account from that perspective. Because when you think about your account from how many trades it takes to blow up your account, it becomes really easy to understand why you want to stick to that golden rule of risk management. And then lastly, what we want to talk a little bit about is having consecutive losses. Because if, let's say, you were loaded up on calls going into this week, you would have had a ton of consecutive losses, all from a single day's sell-off in the markets. So we want to make sure that you understand how to account for consecutive losses, even though your trades are across maybe 10 different symbols. If they're all in the same sector and they're all long, why they're not really 10 different trades. So we're going to talk about that in terms of how to calculate your probability of having a certain amount of consecutive losses and what that translates to in terms of total portfolio loss. And lastly, we'll talk about the risk and money calculator that I've built for you, for those of you that want to calculate this separately on your own. And then lastly, I'll show you how to actually implement it using options play so that you don't have to do any calculation on your own. So starting off, first rule of risk and money management. It's really, really simple. The goal here is to simply risk no more than 1 to 2% of your entire portfolio per trade. That's it. That is the golden rule. So what I have here on the right is a chart or a table rather, which has your account value and how much you can risk in your account based on your total account value. So if, let's say, you have a $20,000 account, on every single options trade you make, you should risk no more than $200 to $400, somewhere inside that range. So what that also means is that if you're looking at a trade like Amazon and you see that the trade costs $2,000 to make that options trade, that means that that's a trade that you should not be taking if you have a $20,000 trading account. And keep in mind that when I say $20,000, this is referring to your discretionary part of your portfolio. So if you have, let's say, a $500,000 IRA where it's predominantly in diversified ETFs, in a model portfolio where you have 60% equities, 40% fixed income, and you have $50,000 on the side that you're playing around with, I'm referring to that $50,000, not your total $500,000 portfolio. So keep that in mind. First, you want to start off by looking at how much do I actually have at play, how much do I have to play with, and what is 1 to 2% of that amount, because that's going to help you decide how much are you going to apply to each individual trade. And the goal here is to really gain control of your portfolio by focusing on controlling your losses. Because as I'm going to explain to you over the next few slides, everyone is always concerned about how much money can I make. A lot of times we don't think about how much money can I lose, but that's really what's at risk here, is because once you lose everything in your portfolio, you have no more money to even try to make any returns. So the most important thing to do is to actually make sure that you keep enough dry powder in your account to trade another day. Because if you can't trade another day, it doesn't matter how good of an idea you have or how great your technical analysis skills are, you won't have enough money to deploy into the market. So the most important thing to do is to make sure that you maintain enough capital to continue deploying your capital in the markets. So the only way to do that is by by focusing on managing your losses. And the only way to do that is by risking no more than 1 to 2% of your account per trade. Now that we've gotten that out of the way, now I want to talk about why that's the case. Now, in order to really understand why, we want to look at the difference between a linear versus exponential function, because the returns in your account do not follow a linear function. They follow an exponential function. So any of you that have ever learned about compounding returns and understand how powerful they are, it works both ways. It's really powerful if gains are compounding in your favor, but on the same token, if losses start compounding, they also compound very, very quickly. So it's important to understand the power of exponential functions and how it pertains to both gains and losses. And the goal here is to really minimize your risk. Minimizing your risk is critical to maintaining that upside potential, because if you blow up your account, you will no longer have any upside potential. So in order to participate in this upside exponential gain, you must make sure that you have enough capital in your account to even participate. So that's why it's so important to take your time and make sure that you have enough capital to even continue participating in the markets. So again, that's why we focus all of our attention on minimizing losses in order to continue trading another day. So I think once we understand the linear and exponential function difference, we want to take a look at some of the math behind this. So the first one I want to look at is the gains that's required to get back to break even after a loss. So if you have a loss, how much does it take to get yourself back to break even? And what I have here on the chart here is simply the loss that you incur in your portfolio here on the bottom versus the amount that is required to get yourself back up to break even after a large loss. So as you can see here, the gains that are required to get yourself back to break even get exponentially larger as you go further along. So at 10% loss, if you lose 10% of your portfolio, it only requires an 11% gain to get yourself back to break even. So that's almost equal to the amount that you've lost. At 20%, you need a 25% gain to get yourself back to break even. But as you can see, once you get to 30 or 40%, you need almost double the gains just to get yourself back to break even. At 50%, you need exactly double to get yourself back to break even. Anything beyond 50%, it's almost impossible to ever get yourself back to any form of break even, meaning at that point, you've already, at 50% loss, it requires such a large gain that it's almost impossible to even ever get back to break even. You might take 3 to 4 times the amount of time it took you to lose that 50% just to get yourself back to break even. That is a very, very unsustainable model in the long run for trading. Which is why, again, the goal here is to minimize how far down this line you go, which decreases the amount of gains that you need to get yourself back to break even. So what we tend to find is that, generally speaking, if you get yourself to the point where you're going beyond 25% losses, it becomes quite difficult to ever get yourself back to break even, because even at 30 to 40%, the gains that are required to get back to break even are very, very difficult to do. So in order to really prevent yourself from ever losing more than 25% of your account, the question you should really ask yourself is, have you ever risked more than 5 to 10% or more of your account on a single trade? Now, for those of you that have risk more than 5 to 10% of your account per trade, please type yes into the chat window. And please be honest, because that's the only way we can move forward with this, is being honest with yourself as to how much are you actually putting at risk per trade. Because what I'm going to show you in the next few slides is that if you risk more than 5% of your account per trade, you will find yourself exceeding this 25% barrier fairly often in your trading career, meaning you might probably exceed that 1 or 2 times a year. And like I said, when you do lose more than 25% of your account per trade, it becomes very, very difficult to come back from. And I hate to say this, but all the other webinars that I do, all the other technical analysis that I do, the strategies around credit spreads, debit spreads, going long calls or puts, cash secured puts, all of that stuff goes completely out the door if you no longer have enough capital to deploy. So it's really, really important to understand that to avoid having these types of losses, you have to minimize the risk on your account. So I hope that this, I think, is fairly straightforward and easy to understand for users as to why it's so important to focus on losses. And the best way to do that is by minimizing the amount that you risk per trade. Now, this is just the first step. The second step that I want to take a look at is thinking about losses in terms of how many trades it takes to blow up your account. This is not a very natural thing to think about. However, I think this is a better way to think about how much you're actually risking per trade. Because if you find yourself risking 10% of your account per trade, it only takes 10 trades for you to blow up your entire account, which means that if you even have 3 losing trades in a row, you've already lost enough to become quite difficult for you to get back. And I'll show you in the next slide how easy it is to have 3 losing trades in a row. For any of you that have long trades this week, you probably had 3 losing trades just this week alone. So that's why it's so important to think about how much are you putting your account at risk, because for every 1% you decrease per trade, as you can see, the number of trades that you can trade before your account blows up grows at an exponential pace. So at even 5%, you can trade 20 times before your account blows up. At 2%, you can trade 50 times. At 1%, you can trade 100 times. Think about losing 100 trades in a row. That's a lot of consecutive losses to lose in your trading account. I would imagine that if you had even 20 losing trades in a row, you would probably reconsider your strategy. So if you're risking only 1% of your account per trade, if you had 20 losing trades in a row, you'd probably consider either changing your strategy or thinking about trading something else, versus if you had 20 trades in a row, when you're risking 5% of your account per trade, you've blown up your entire account. So this is why it's so important to think about how much money you're willing to risk. And I think the number of trades that it takes to blow up your account is sometimes a better way to think about how much are you actually putting at risk, because losing 100 trades in a row sounds pretty absurd and sounds quite unreasonable or quite difficult to reach there. So that's really why it's so important to think about it in these particular terms. So as you can see, when you risk 5% of your account per trade, this will actually result in 25% losses quite often. So, and I'll show you in the next slide as to how often that typically happens. But again, that's why you want to keep yourself within this threshold of 1 to 2%, and you want to stay below that threshold so that you have anywhere between 50 to 100 trades to blow up your account, which is a fair amount of buffer, I would say, for most users. So with that, what I want to talk about is the probability of having consecutive losses. So we've talked about how much you're willing to risk per trade. So what if you have 5 losing trades or 10 losing trades? What is the probability of that actually happening? So with most option trades, you'll see that, depending on the option strategy you deploy, you'll see that your win rates are usually somewhere in that 30 to 70% range. So for those of you that are buying calls and puts all the time, you're generally going to see yourself in the lower end of the spectrum, so around this 30% area. For those of you that are selling credit spreads, you will find yourself in the higher area, in the 70% area. And then most of you will probably be somewhere in between in this 40 to 60% win rate, depending on the type of option strategies you typically deploy. And what I have here on this chart is the probability of having consecutive losses based on the strategy that you trade. So for example, if you're trading credit spreads and you're selling credit spreads that have relatively high probability of profit, you'll see that you have a pretty low probability of having 5 to 6% losses. So, in the 60% range, you have anywhere about a 1 to a little under 1% chance of having 5 to 6 consecutive losses. For those of you that are trading debit spreads, you have a higher chance, about 4 to 7%. So generally speaking, depending on the strategy that you're deploying, we generally tell you that you should plan for having at least 5 to 6 consecutive losses at some point in your trading career. And that should happen, I think, at a, usually at least once a year. If you think about downside corrections like the one we had in December 2018, or, this week, I would say is a fairly minor version of it, but I think things could still get quite ugly. When we have these 3% sell-offs in a single day, usually they're not isolated events. Usually they tend to be followed up by some more downside moves. So if the market does continue to correct down to 250, 260 on the on SPY, we can have some significant consecutive losses. So we can have another December 2018, and the last one was just 8 months ago. So you can see how easy it is to have 5 to 6 consecutive losses once or twice a year. And, to be honest, we're seeing them a little bit more often than we used to. We are, the market that we're currently trading in, the environment that we're trading in, is very much extremely calm for many months, and then these violent downsides. And a lot of times, during these very quiet months, the only position is to be long, and then all of a sudden you have these very, very violent, massive sell-offs that really hurt everyone. So it's so important to plan for having these potential consecutive losses. So the goal here is to make sure that the percentage, you want to make sure that you keep the consecutive losses multiplied by the percentage of your portfolio that you risk per trade to be less than 25% of your entire portfolio. So if you risk 2% of your account per trade and you have 5 consecutive losses in a row, what that means is that you have roughly about a 3.13% chance of a 10% portfolio loss. That's if you have roughly a 50% win rate. So you can kind of adjust this based on your win rates. So if, let's say, you sell credit spreads, then you have maybe a 1 to 1.5% chance of having 5 to 6 consecutive losses. If you have a 50% win rate, you have about a 1.5 to 3% chance of doing that. And if you are trading debit spreads or strategies that have lower probability of profits, you have a 4 to 7% chance of that happening. So this is really, some of the things that you need to consider with your trading strategy as to what is the probability of having these 5 to 6 consecutive losses. But we generally find for most of these strategies, you need to plan for at least somewhere between 5, 6, possibly even 7 consecutive losses in a year at some point throughout your trading year. And this is something that's really, really important to understand. Now, I will say that sometimes this formula is actually quite misleading. And I mean that because many times when we trade, we tend to have concentrated positions that we simply need to group together for this specific perspective. So for example, if you had a bunch of long trades this week, let's say you had all calls going into this week, then I wouldn't really group that as consecutive losses. That's really just a single loss, because when you have all of your trades concentrated in a single expiration, if they're all long and if they're all in the same sector, that is grouped in the same sector. So for example, what you really want to do is distribute your trades across different expirations, across long, short, and across different sectors. And this is really why, the take that we have here at Options Play is to always have some long and short positions, especially when you go into kind of overextended times, even when the market is heavily skewed to the upside, to have a couple of short positions in weak sectors so that when the market corrects, you have some downside so that not all your positions are concentrated in long positions. So, on the day that the market sold off 800 points, we took profit on some of those short positions to offset some of the losses we had on our long positions. So to think about your portfolio loss, we actually not only have to think about how much money do we have at risk per trade, but also what concentration do we have on each expiration cycle. So if, let's say, you have 2 long trades that are expiring on the same day, then instead of just having 2% of your account per trade, you have to multiply it by the number of trades that you have per expiration by the number of consecutive losses. So before we talked about a 3% chance of having a 10% loss. If you have 2 trades per expiration, you have a 3% chance of a 20% loss. Now, that's still within an acceptable range from my perspective. But if you're the type of trader that loads up on a single expiration and you have 5 trades all expiring on the same expiration, then what you have here is effectively, granted, you're sticking to the 2% rule, but if you have 5 trades all expiring on the same expiration and they're all long, now instead of having a 3% chance of having a 20% portfolio loss, you now have a 3% chance of a 50% portfolio loss. So it's really important to understand not just risk per trade, but what is your total portfolio at risk? And if you have all of your positions concentrated in a sector and they're all long and they're all in the same expiration, you have to account for a different amount of portfolio risk compared to just someone who has a single trade at risk. So it's really important to understand this not just across a single trade, but across your entire portfolio. And lastly, there is another way to control your loss. And many times, some of you deploy this in your trading strategies of using stop losses. So stop losses can reduce your overall portfolio risk as well. So for example, if you are the type of user that does stick to the 2% rule and you are trying to account for 5 consecutive losses in a row, this means that you have a 3% chance of having this should say 10% portfolio loss. However, if let's say you do the same trade with 5 consecutive losses, but you put a 50% stop loss, then you have a 3% chance of this is a 5% portfolio loss, because 2 times 5 is 10% with a 50% stop loss. That is a 5% portfolio loss. So that is a typo. I will fix that before I send that off for the slides for everyone. But this is just a way to think about that. You don't have to just think about portfolio losses in terms of how much capital you're putting at risk, but you can also think about having a bit of a buffer if you do use stop losses in your trading. So this is all why it's so important to really look at using these types of rules to help you control your losses around your trading, so that even if you have bad weeks like this week, that you only put a small amount of your portfolio at risk, so that even bad weeks do not put you in a position where you've lost so much of your portfolio. You really need to put even more risk just to get yourself back to break even, which is a position that you never want to be in. And I will say that I think most traders have probably found themselves, especially newer traders, have found themselves in that position where maybe you've lost 30-40% of your account on a few losing trades or a few consecutive bad weeks, and you find yourself in a desperate position to get yourself back to break even. So you end up risking even more on the next few trades, only to have that, even a single one of those trades work against you, and you're effectively lost 50-60% of your account. I've seen that over and over again as a strategist. As a market strategist, have been fortunate enough to work with thousands of retail traders over the last 12, 13 years. And as a result of that, I've seen a lot of these types of losses. And I really want to stress how important this lesson is for all traders, that really makes all of the other trading that I do completely obsolete if you're not following these types of rules, because all it takes is a bad month like December 2018 to wipe out all of your potential gains and potentially wipe you out from even trading altogether. And I really want to make sure that those of you that spend the time, taking the time out every Thursday to attend these webinars and take the time to learn about option strategies, that you also take this lesson to heart, because it really allows you to sustain yourself as a trader in the long run. So with that, again, just to reiterate, that what you want to do is you want to make sure that you have a set dollar amount you're willing to risk per trade, and that dollar amount, again, is driven based on your account value. So depending on your account value, you want to make sure that you stick to a number in between these two numbers that will help you determine how much you want to risk per trade. So for example, if you have a $50,000 portfolio, and again, I want to reiterate, the $50,000 refers to your discretionary account, not your entire portfolio, if let's say you have a retirement portfolio that's $500,000 in diversified, equities, fixed income, and all the other things that you put into your long-term investing strategy, this is not for the $500,000 portfolio. This is for the discretionary portion of your portfolio that you're playing options with. So if you have a $50,000 portfolio, 2% of that is $1,000 per trade. So if you're looking at a trade that has $200 of risk per contract, then that means you can trade a total of 5 contracts on that trade. And that also means that when you're looking at a trade that, let's say, costs $1,500 or $2,000, you should not enter that trade at all, because you are putting more of your account at risk than you should be on a specific trade. So especially for those of you that have smaller portfolios, if you have a $20,000 portfolio and you can only risk somewhere between $200 to $400 per trade, that does put a lot of trades outside of your scope. And you need to be disciplined enough to not trade those. If a trade comes out to be $500, you still need to ignore that trade and not trade it, because it's outside of the scope of your portfolio until you have $25,000. That's when you can start trading those contracts that have $500 worth of risk. So it's really important that you make sure that you utilize these types of rules to help you stay within the lines. And to help you make these calculations, I've created a free worksheet that those of you can just download. I've just put that into the chat window for those of you that want to download this risk and investment calculator. What it does is it allows you to input your portfolio value. It allows you to put in how much of your account that you're willing to risk per trade, and what it will spit out is the amount that you are allowed to risk per trade on every single trade. And when you're looking at a specific trade, what you can do is you can input the amount of risk per trade, and what it will spit out is the number of contracts that you can trade. And this is all designed to make your life as easy as possible. Now, this is for those of you that don't have access to options play and you want to be able to do the calculations that I showed you here today. But for those of you that have options play, we already have all of this pre-built into our risk and investment calculator, which I'll show you guys in 1 minute. So just to recap, I covered a lot of things. I talked about a lot of different math. Most of it, I think, is fairly simple to understand. But for those of you that need some time to follow this along, this is recorded. I will send the slides out to everyone so you can do this at your own pace. But the golden rule of everything that we're talking about here is to simply risk no more than 1 to 2% of your account per trade, and to remember that returns and losses compound exponentially. So it's really important to understand how this is designed to help you minimize your portfolio drawdown, because that's the only way you'll have enough capital to continue deploying your money to try to make a return in the markets. If you blow up your account, you won't have enough capital to continue trading. And whenever you're trading any option strategy, you want to plan to have at least 5 to 6 consecutive losses in your account sometime throughout the year, and making sure that when you do have those 5 to 6 consecutive losses, it doesn't blow up half your account, because if that does happen, it's almost impossible to get yourself back up to break even. And lastly, whenever you're trading options, you want to try to distribute your trades across sectors, across expirations, and also across long short, so that you don't have too much exposure in a specific expiration sector or in long or short. This way you can survive violent weeks like we had this week. Even though you might find yourself wanting to trade more, sometimes it's more important to hold yourself back so that you don't have weeks like this blow up your entire account. So with that, what I want to do is I want to jump over to options play and show you guys a few examples of how we utilize this tool to quickly implement the things that we're going to show you here, what we talked about here today. Now, earlier today, we sent out a trade idea on Coca-Cola. And I'm going to use this as an example to help you guys better understand how to apply what we're teaching here today. So the trade that we were talking about here today was the September 20 52.5, 57.5 call vertical that cost $182 per contract. It actually cost a little less when we had traded it, but this is the closing price as of today. The midpoint was 178. So one of the tools that we have available to you in options play is a risk and investment calculator, and it's on the third dot here at the bottom of your P&L simulator. So what we do is we allow you to do this in two different ways. You can choose how much you're willing to invest, or you can choose how much you're willing to risk. So one of the things that I'll do is I'll bring up the risk and investment calculator that I just showed everyone here today. And what I can do is I can use this to, let's see if I can change this. So let's say I have a 50, oh, maybe I should download this, sorry. Let's open this in Excel. What you can use this tool is to put in your account value. So let's say you have a $50,000 account. We're willing to risk 2% of our account, which is $1,000. So what I can do is I can take this $1,000 and input this into options play. So I can say that I'm willing to risk $1,000, and I can click on I want to risk. And what this does is it automatically calculates for me the number of contracts that actually puts me within the range of risking no more than $1,000. So this automatically calculates that I can buy 5 contracts of the September 20th 152, 157.5 call vertical. So this does all the work for me so that I can use my P&L simulator. I can say that what happens if this stock goes back up to that $55, $56 target the price that I have on this particular stock, as I can see that I can make an $860 profit off of the $890 that I'm risking, so that you have a better sense for how much money you have at risk and how much money you can potentially make on a specific trade. And all you have to do is you put in the amount that you're willing to risk per trade. Now, this number really should not change very often. It should only change as your account value grows or declines. So if, let's say, a couple of months later and I deposit some money in my account and now I have $70,000 in my account, now I can risk $1,400. That's really the only time where I want to change these numbers. So now, let's say a few months later, I make some deposits. Now I have $70,000. So now I can trade 7 contracts. So this is how you can adjust the amount that you're willing to risk per trade. And if, let's say, I go through a string of losses and I have some losses and my account goes down to $60,000, then I know now I can only risk $1,200. So now I would just input $1,200 into my account, and it would tell me the amount that I'm willing to trade, that I can trade to stick within my range. And this is all designed to help you better manage your risk. So every time you look at a trade, I'm looking at a trade today, Universal Display, very strong stock, rallying pretty strongly. I was looking at this, and this cost $1,500 a contract, and I thought that was quite expensive and a little outside of the range that I wanted to trade. So I decided not to pull the trigger on this specific trade. Last week we put out an Amazon trade that cost quite a bit. So this is really something that you want to utilize options play to help you decide whether this is a trade that you want to make. Even if you're making a really cheap Amazon trade like the one that we sent out on Monday, if this is just not for you, then this is something that you want to utilize options play to help you better understand. I think it was the 183.5, 1855.5. It was around $1,800 or so at the time. And this is really something that you want to make sure that you check to make sure that you stay within your range. If something is outside of the range, then you want to make sure that you don't trade that so that you don't blow up your entire account. And we really tried to make this as easy as possible so that no matter what symbol you type in, you can quickly see how many contracts you can purchase. So for something like eBay that only costs $113, if I'm willing to risk $1,200 on a trade, As you can see, I can buy 10 contracts of this. So this allows me to trade 10 contracts, but something else that costs more, I might be able to trade 1 or 2 contracts or not be able to trade at all. And this is really how we use the risk and investment calculator to help you stay within your lane. So with that, that covers what I wanted to talk about here today. Again, I can't stress how important this topic is for those of you that are trading options today, whether you're experienced with options trading or you have been, or you are just starting out. This is arguably, in my opinion, the most important topic for you to learn before you start your options trading, so that you don't start trading options, blow up your account, and not come back to options trading altogether. So with that, I just want to thank everyone for taking the time out here this afternoon. For those of you that do not have access to Options Play, the link that I just sent to everyone in the chat window is the one that you can utilize to sign up for a free trial. And at this point, what I'll do is I'll open this up for Q&A, so that if you have any questions regarding anything I spoke about here today, please type them into the chat window, and I will try to answer as many questions as I have time for. So looks like I have a few questions here. Stan, on the GDX trade, I'm not sure what you're referring to. If you can send me an email at info@optionsplay.com, I'm happy to take a look at that for you, but I'm not exactly sure which one you're referring to. Brian's asked me, could you also address cash secured puts, please? So Brian, I have a whole webinar just on that alone. If I do recommend, for those of you that are learning about different strategies, you can visit our YouTube channel where we have all of our latest videos, including cash secured puts. So I'm going to send you a link to our YouTube channel with all of our playlists, and you can find yourself the one on, where's cash secured puts? Discounted stock purchase with cash secured puts, number 17. That was from February, so it's probably time for a new refresher on that. But I highly recommend you to take a look at cash secured puts. But I am going to talk about it on our webinar next week. So if you do come to our webinar next week, I will talk about cash secured puts then. Let's see, Brian saying, oh, actually, I just finished that question. A lot of you said that you did have, you did risk more than 5% of your account. And some of you said, I've learned my lesson. Some of you say you followed the 1 to 2% rule, which is great. Wayne is asking, does this discussion pertain only to actual losing trades or also to mark-to-market? Wayne, we're talking about actual losses. So we're talking about the amount that you're willing to risk per trade, not just what you lose mark to market. Harry, how do you calculate the amount at risk when you sell a put? Great question, Harry. So when you're selling a put, that's really for stocks that you're willing to purchase. So from my perspective, you want to first look at how much are you willing to purchase. So let's say I'm selling puts on eBay, and you have to ask yourself, how much am I willing to buy of eBay stock? Because that's really what you're doing when you're selling a cash secured put. So let's say I want to buy $15,000 worth of eBay. It'll tell me that I can purchase 361 shares of eBay. So for that, I would sell roughly 3 contracts of eBay. So that's why we have these 2 calculators. We have I want to invest, and I have I want to risk. So for those of you that are selling cash secured puts, you want to use the I want to invest aside, and you want to put in the dollar amount that you'd be willing to purchase the stock. So you enter the amount that you're willing to purchase. It will calculate the number of shares and the number of contracts that you can purchase or sell. So when you're selling cash secured puts, it's really contingent on how many shares you're willing to buy. Sue is asking, last Christmas, I lost nearly 50% of my account trade on SPX. So Sue, I think that is, I believe that was actually the reason I started doing this topic, was because December 2018 was a painful time for a lot of people, including ourselves. We were selling puts going into December. We were fairly confident that fundamentals did not look weak to going into December as the markets were selling off. We were pretty confident the market was going to have a pretty nice bounce as the market sold off. And we experienced quite a bit of pain ourselves because the markets did end up correcting further than we had expected. But I will say that if you follow the 2% rule and you had distributed your trades across multiple expirations, when the market bounced back in January, a lot of those trades, you may have taken, you probably took some losses in December, but in January you would have made quite a bit of it back. Unless you had loaded up going into December, you should not have lost more than 20 to 25% of your account per trade following these types of rules. So this is really, why, December 2018 was a tough time for everyone, but this is really why I decided to start teaching about this topic. And I've done this webinar, I think, twice since then. And I think this week was just another good time to revisit this topic, because as severe as the sell-off was a few days ago, it was, I think, of small comparison to what we saw in December. But it was a good reminder as to what can happen when markets do turn violent. John is asking, is a 30% stop loss cutting it too close? John, I tend to find that with options, 30% is too close, because many times just the spread alone. So, 105 to 113, that's a 8-cent spread on $1.09. That's almost 10% right there just on the spread alone. So 30% stop loss, I tend to find, is a little close on options, in my opinion, because you're already losing close to 10% just on the spread. So that's why we usually use about 50% loss on the options side. Eric, stop losses on a credit spread skews the probabilities, correct? Spreads are defined risk to begin with. Comment. Eric, absolutely. So with credit spreads, it certainly will skew the probabilities, and you're absolutely right. If you're selling a credit spread and you're comfortable with the risk that you're taking, then absolutely. Generally speaking, when we sell credit spreads, the only time that we take losses on a credit spread is if simply the underlying stock did not go in the direction that we expect it to. So here, if let's say on eBay, I sold the 39 puts and I bought back the 37 puts because I believed eBay was going to stay above 39, and the stock drops to 38. I would say that I was wrong on my analysis, and I would simply get out of the trade as a result of that. So that's my thesis on taking losses on a credit spread. Rick is saying, ignorance alert. Can you place stop losses on options? Rick, that is not an ignorant question at all. I think that's actually a really great question. Absolutely. It does depend on your broker, but most brokers support stop losses on your options trades. Let's see. Does the method to put a stop loss on a typical debit trade? Discuss the method to put a stop loss on a typical debit trade. I'm not sure what you mean by discuss the method. You simply place a stop loss just like you do on a stock trade as you do on an options trade. Explain trade costs. Trade costs is simply the cost it takes to enter the trade. So here in this particular eBay trade, it cost me $452 to buy the September 4044 call. I'm sorry, this is 4 contracts of it. So basically it tells me the exact dollar amount that I need in my account to enter this trade. So you need buying power of $452 to enter this trade. That's what trade cost refers to. Mitch, what is your formula for setting stop losses? So that really depends on what strategy we're talking about. So I like to trade debit spreads because the rules for setting stop losses are really easy. You cut your losses at generally 50%. If you're trading other strategies, it really depends. So it's hard for me to comment without knowing what strategy you're referring to. John, I think you asked your question about 30% losses. I think I've answered you. John is saying Fidelity lets you put stops but not trailing. You have to enter each day. John, you can put a stop loss that's good till cancel. You don't have to put in an end of day stop loss. So you can, unless you're changing your stops every single day, which I don't necessarily know that you need to do that, but you don't have to put in a stop loss that's only good, that's end of day. You can do it go till cancel, so you don't have to do it every single day. Frank is saying, so I'm just a beginner. Your discussions are primarily towards option buyers. Wouldn't the risk therefore be different? No, because if you're selling option sellers, you still, for sellers, you still have risk and you're really defining your risk. So if let's say you're selling a credit spread, you still have a max risk. And you want to make sure that that max risk stays within that 1 to 2% of your account value. Keith is saying, can you stretch the percentage when you are looking at cover calls? How does the equity value figure in? So Keith, this does not apply to cover calls at all because cover calls does not add risk to your portfolio. Cover calls reduce risk of your portfolio. So cover calls is the only strategy that this does not apply to. John is saying we're up 18% on the Coca-Cola trade as of today's close, which is great to hear. Frank, yes, I think I understood. You're saying it's different for option sellers. So again, if you're selling cash secured puts, it's how much you're willing to risk is dependent on how much money you're willing to place on that stock, right? So you might be really willing to risk more than 2% of your account on buying a stock. Many times, I think most people will go up to 5, possibly 10% of their account per stock. But so, I tend to stick to the 5 to 10% rule for buying stocks. So if let's say you have a $50,000 portfolio, you might want to buy no more than $5,000 worth of stock in one single stock. So in this particular case, that's 120 shares. So I would sell one contract on this specific name. Ramesh, you're very welcome. Brian, you're very welcome as well. Robert is saying, I bought the option on Zillow, but after earnings, the disclosure, my trade went south. So absolutely. So this is really why we want to plan for these trades, so that even when a trade like this wipes out everything, and unfortunately this trade did not work out, that this is only accounting for no more than 2% of a loss in your portfolio. So this is exactly why we plan for this ahead of time, not after we've made, which is why we always plan for the worst case scenario, and we're always okay with accepting a 2% loss in our portfolio. So even with a catastrophic loss, it only accounts for a 2% loss from our entire portfolio. Caesar, question off your theme. Do you plan on providing the portfolio tab the opportunity to track your own ideas? Caesar, yes, absolutely. We're actually working on that right now. We hope to allow you to enter your own portfolio manually in a couple of weeks. And then by October, we will be able to allow you to automatically pull in your portfolio from your broker. John is asking, why does it seem that most options start out in the hole? It seems so difficult to recover the starting cost due to commissions and the entry point. It seems that the cost is too high. What can we do the entry cost to say less than $100? John, I'm not sure what you mean by that, because the cost of a trade is the cost of a trade. So that's like saying that Zillow or Amazon's too expensive. You just buy less contracts of it if you can't afford that. So it doesn't matter how much it starts with. It's just a matter of whether it goes higher or lower from that starting point. As far as how high that starting point is, it really has nothing to do with whether that trade will go in your favor or against you. Wayne is saying, is it possible to place a stop loss on a spread trade? So Wayne, again, that depends on your broker. So I would call your broker to ask them what option orders they support, but they should be able to support a stop loss on a spread trade. Row, so a naked long call or put should stop loss at 30 to 50%. If debit spread 30 to 50% also, would you sell another contract if not performing? When selling naked calls, puts stop loss at 1 to 200%. So Ro, you asked a lot of questions in one question. So generally speaking, all of the questions that you've said are absolutely correct. I just would not sell another contract if it's not performing. That's not my style of putting on more risk when the trade doesn't go in my favor, because putting on more risk just means that I'm stepping outside of that 2% bound. So if I'm willing to risk 2% of my account per trade and it doesn't work out, then I lose 2%. I don't want to put 4% of my account on a trade just because the trade's not working out. That's how you get yourself into trouble in the long run. Serge, I'm not sure what you mean by make an alarm or alert in OP. Something that we're certainly, if you don't mind clarifying, I'm happy to take a look at that. Ramesh is saying, is closing the short leg vertical in a down week a good idea? Ramesh, that is a more advanced strategy, but if you do, so for example, if let's say, let's go back to the Coca-Cola example. So we sold the 57.5 call. Let's say the stock pulls back to 52, and you think that this stock is going to go back to 57 after touching 52, then yes, you can sell or buy back the 57.5 call for a fraction of what you sold it for, and hope that as the stock rallies that you basically take advantage of it. So absolutely. But I will say that that strategy generally works when you get a quick move to the downside immediately and you want to remain that upside exposure. But if it takes a few weeks and it just kind of moves along, then many times that it doesn't really make much sense. You might just want to close out the whole trade. Andy saying, could you please post the risk calculator spreadsheet again? Absolutely. 1 second. Let me just find that link. Andy, I just posted it into the chat window. Here, I can enter it into your Q&A window as well. So any other questions before I sign off for today? Sue, you're very welcome. So I'm really happy that so many of you decided to attend this webinar here today, because again, like I said, I think this is by far one of the most important lessons to learn. Sounds like some of you have already learned it, which is great. For those of you that are still starting out, unfortunately, I tend to find many traders don't learn this lesson until they have lost a decent portion of their account. But I'm hoping that this message gets to some of you before that happens, to help prevent you from getting into that habit. And we tend to find that this habit tends to form after you have a string of winners. You get a little excited about what is the possibility of what's going to happen. Maybe you have 5, 6, 7 winners in a row and you think that you're invincible, and you start to take on more risk. And what happens is all it takes is just for a few losing trades in a row to blow up your account. And I'm really hoping to get ahead of that curve, so that when you do have that string of losses and you feel that you're finally, hitting a stride, and you feel that you have a good grasp on your strategy, that you still stick within your lane so that you don't blow up your account, because that's the only way to continue trading. And unfortunately, sometimes people don't learn that lesson until they've actually had that string of losses. But I will try to warn many of you that many times we see users that do take on more risk than they should, tends to happen after they have a string of winners, not after they have a string of losers. So just keep that in mind when you find yourself in that position where you feel that you've have a good grasp on your strategy, you've had a string of winners, and you're thinking, oh, now it's time to trade larger so I can make more money. Think twice when that thought pops up in your head, and hopefully that will help you stay in your lane. So thank you so much, everyone, for taking the time out here this afternoon. Thank you so much for everyone asking all the questions and participating and giving me feedback and telling me about your experiences with trading. That really helps us, or at least me, with providing you guys with feedback and topics that are relevant to your options education. And I'm really excited about the next few webinars, because I'm going to be talking about how to enhance your equity position using options. So, I've been doing a lot of these educational webinars. I feel that I really have a good grasp of option strategies or core strategies that you guys really like, that is really useful for your trading. So the next 3 topics I'm really excited to talk to you about, guys, about. Next one is enhancing your equity positions using options, and then debit spreads, and then credit spreads. I think 3 of my favorite topics this month. So I really look forward to seeing you guys over the next 3 weeks. And I hope you guys have a great trading week, and I'll see you guys next Thursday. Have a great evening.